Well, let me start with this. Good morning, good afternoon, and good evening, traders from across the globe. Thank you for tuning in. Metastock, you put on such a great presentation as always, and I'd like to give you a special round of applause. Metastock, thank you, and thank you for having me. Traders, some of you may know me, some of you may not. I think you will be loving me at the end of this chart segment if you're worried about which way the market's going to go, the stock market in general. Are we going up? Are we going down? What's going to happen? Well, I think the charts will tell us exactly that. If you like what you see in this chart segment, of course, I will show you where you can find me. I'm live in a live trading room, microphone and camera, basically every waking moment of my life because I live there and I do this for myself. And I let a bunch of traders look over my shoulder and hang out with me. So if you would like to join me, of course, I will show you towards the end of the presentation where you can find me. I do a YouTube video every night or just about every night. That video will tell you what I expect to happen the very next day in the markets. Then you will find me live in my trading room acting out that very video with all of you OMNIacs. So we'll get to all of that later. What I wanted to do today was I wanted to show you something that I find very interesting. So let's just look back at this piece of paper for a moment. We looked at charts together. This crowd from Metastock and myself here, I put together a webinar in February, and in that webinar, I basically said, this is how the stock market bottoms are born, and the bottom is in. And of course, you can watch this video in its entirety. It was filmed on 2/7. There is a video almost every night, by the way. So after that video, I started to do webinars, and I will tell you right now, many people in those webinars or many people who watch those webinars are absolutely on the other side of the token, and they are calling for the downside of the stock market. I only call what I see. I have no professional opinion about which way a market is going to go. I use the chart to tell me where it's going to go. So we looked at charts in February. We thought the bottom was in. I did videos and seminars and webinars, and I've been calling the bottom since. Where are we now? That's what we need to find out. And this is what's going to be nice about this presentation is I'm going to use the exact same charts that we used in February together. I left notes on the charts, a needs, like a needs list. Each chart, if we left a needs list off to the left, and then we hope those needs were filled to keep the market bullish and prove the bottoms in. And then over here, we'll see where we are. So I'm going to take you back to the S&P chart, this exact same chart that we used in our webinar in February when we said the bottom was in, but the needs were this. It must get above the 200 bar moving average, which is this teal average right here. So it's got to get above this average, and it was not. It was down here, and it wasn't above the average, right? So one of the needs that we have on the list is you must get above the 200 bar moving average to keep the market bullish. Well, it gets above the 200 bar moving average right here. First time. Now we're above. What else did it need to do on the needs list? It needed to get above this red resistance line. So we are now getting above the red resistance line, or I should say we are well above the red resistance line. We actually came back down and tested the lows, tested the 200 bar moving average, tested the red resistance line, and have bulled up into a bull flag, which means everything on our needs list has been met, which means the market stays bullish. The ES is now above the 200 bar moving average. It is above the red resistance line or resistance channel. And it is now in channels like this one that are bullish. It's now in a bullish channel and in a bull flag. So it shows that in February when the bottom was coming in and the charts proved that the bottom would be coming in, that it was the bottom, but that's only one chart. And one chart would never be able to prove that we will work higher this year, not lower. So we're going to look at a bunch of other charts, the very same charts that we looked at in the beginning of this year in February, and we'll see where they stand now. So let's just go to the next one. I've got a ton of these, so we'll try to get through them quickly. The NASDAQ chart needs. The NASDAQ needed to get above the red resistance line. That's this red line right here. We were going to need to get above that. What else do? We need to get above the 150 bar moving average, which is a sell trigger. Okay, so looking at the chart from where it was, this is a sell trigger. As you can see, it's 150 bar moving average, and every time you get near it, it becomes a sell. Again here, you finally get back to it, the blue line, and it becomes a sell. Well, we need to get above that. We did right here. It is working. The markets are getting more bullish. The market is changing complexion was the note that we put in when it was all the way down here at the lows. As it started to make this upward projection, or trajection, I should say, once the trajectory started, we started recognizing its changing complexion. We called bottom, and we gave a much higher level for the market to go this year. I will say, looking at the charts so far, we are now above the red resistance line. That red line, we are well above it, right? We got above it here when we got above the 150 bar moving average. So it's also above the 150, and it's become a buy trigger. That's different. It was a sell trigger. Every time you went near it, here it was a sell, here it was a sell, here the 150 bar moving average was a sell. Suddenly it becomes a buy trigger, and that is our buy trigger. Takes off from there. It's in a nice bullish channel right now, and I have to say, I think we're right so far, and we'll go over all the charts, but I don't think we should be looking for the downside. I think we continue to look for the upside. According to these charts, you're now in a nice green bullish channel going upwards. No more downwards channel like this was. Complexion has changed. Well, that was back in February. Look how much better it looks today. I am telling you, the people out there calling the downside, I think they're using personality. I think they're using fundamentals, and the fundamentals look horrible. But if you use the chart says ignore the fundamentals. We are in a bullish market right now, not bearish. All right, that's been two charts. Let's see what else we have to make that point. So if we move further, we'll look at, let's see, I got a whole bunch of these pretty little charts. We're going to start here. We just did NASDAQ. Transportation average, third chart. So this one is the chart that I can show you that actually has an argument for the downside, but it's the only one that I can find. So of the indices charts that I follow, let's go over this one. It started with this capitulation day top. Market rallied up. We knew that was capitulation day. The market has ever since been breaking. The needs that were on this chart was it needs to get above the 200 bar moving average, and it needs to get above the red resistance channel. That red resistance channel, of course, as you can see, is this one. Big channel here, right? Resistance, support, support, resistance. So it's in a big channel. So one of the needs is it's got to get above that channel, and it does get above the channel. After a little dip, it gets above and stays above. What else did it need to do? It needed to get above the 200 bar moving average. Well, let me blow this up a little. We are above the 200 bar moving average. And it's in some sort of an upward trajectory. You can tell by these blue lines. But the problem on this chart is it's got a little bit of a head and shoulders, right? This could literally be a left shoulder. We'll find out soon enough. We're not going to call it that until if it breaks down, then we know it is for sure. But it looks like it's building into a head and shoulders. Now, this would be contrary to everything else that we've looked at so far, but we've got to look at all the charts, and we're certainly not going to hide from the ones that look different. So it is currently above the 200 bar moving average, one of the needs. It is currently above the red resistance channel. However, it is in a possible head and shoulders formation, which should point towards the downside if, in fact, that turns out to be a head and shoulders. The thing I'm wondering about this one chart is it can't just be one chart. That's not the way this works. So we've had S&P looking good. We've had NASDAQ looking good. You don't have the transportation average looking as beautiful as you'd like, but it's the only one so far, and we're going to go through a bunch of others. So it's the only doubter that we're in a bullish market at this point. But there's plenty of pretty little charts for us to look at, so we'll find everything else that points in either direction. So after looking at the transportation average, we looked at crude together in our last webinar. Now, in the crude, we figured I would just show you what was a really smart tip to use on crude for you to decide which way crude will go. projection direction was. So as it turns out, the crude oil is doing exactly what it was doing back in February when we looked at it. And here's the tip on the crude oil chart. Staying below the 100 bar moving average is key to crude oil's direction. And as you can see, it is like magic on this chart. Look at all the times it just stops cold and turns direction at the 100 bar moving average, simple moving average on crude. All right, well, if you're going to use something today, make sure that you know when you get to that 100 bar moving average in crude, something dynamic will happen. It will stop and drop. Or if you can get above, you've got a rally coming your way all the way up to the top of the red channel maybe. So what I want you to keep your eye on for crude right now is the 100 bar simple moving average. That is your trigger. And I will tell you that below 77, the price of crude is actually a buoy for the stock market. It keeps the stock market buoyant, or it helps to. So crude being lower actually helps to usher in my thesis that the bottom is in. And we thought that in February of the year. And so far, we've been right about the stock market. Cheaper crude would absolutely help that to be possible. Now, you see crude's been stuck in this channel, and that 100 bar moving average is your trigger. Just wait for it to get back up there, and that should help you out greatly when you trade crude next. And just to show you the price, let's see what price comes in. We come in at about 76.70, somewhere right around there in your crude on the 100 bar moving average. Now, those averages will shift and change from market to market, and sometimes Wall Street abandons the 100 and goes to a 200 or a 50 or whatever. The 100 is working really well on crude, so it's the same tip that we used back here in the past. We'll continue using that tip on crude oil. If you've got questions, I will answer all of them, but let's wait until I get through this chart segment, and then you let me know what you'd like to speak to me about. So after we looked at crude, we looked at T-bonds. All right, so this was another chart that was in our chart segment. Now, bonds, this brings in a fundamental. Here's the fundamental in bonds right now, this guy right here. The Fed must pause at this juncture. They must pause raising rates at this juncture. They're done. If they continue to raise rates at this juncture, what you're looking at is something that all of us couldn't possibly avoid. What I mean by that is what you're looking at is the possibility of 7 to 10% return. So you would get a 7 to 10% return from the stock market or the OMNI S&P. At the same time, you right now can get 5.25% return with zero risk, zero, to your portfolio. So, are you willing to risk 100% of your portfolio? You know what? Let's put this in a frame. This way we can both read it. Would you be willing to risk 100% of your 401k to get 7 to 10% out of the stock market? Yes, that's what we all do. But if the bond market's willing to give you 5.5 to 6%, why would you even risk a dime to get between 7 and 10? You wouldn't. What's going to happen if the Fed continues raising rates any further is that you are going to get something that's a flight to quality, but that flight will be this: out of banks, out of stocks, and into bonds. And this, what will happen is the Fed will become the entire market. They can't allow that to happen. So I am telling you now, these charts are telling us that the Fed is going to pause. They're going to go in a pause mode and stop raising rates. Now, that's the fundamental. Let's go look at the technical. Just wanted to make sure I mention this to you because it's definitely what's going to happen next. If the Fed continues raising rates, they're going to put us and themselves in a really big box. The stock market's going to crack. Banks are going to get hammered because everyone's going to put their money in bonds, and the Fed's going to be holding up all of it. They don't want to be able. They don't want to have to do that. So the needs list was it's got to get above the 150 ball moving average. It actually did right here. Bonds got above the 150 for the first time in a long time. Look at how the 150 ball moving average for a long time kept bonds in check while it's above it right now. That's interesting. So we are above, thankfully, 150 ball moving average. We're finally in a channel moving towards the upside, not the downside. And if you ask me right here at this policy shift, when the Fed went from full points to half points, then they went to quarter points, I think the bond market recognizes that the Fed is almost done because look, now it's going in this direction as opposed to this direction, which is the way it has been going for such a long time, right? For the longest time, you had bonds moving lower. Let me explain to you how this works. When bond futures move lower, rates go up. When bond futures go up, rates come down. You've had bond futures falling apart, rates going up. Now they're starting to level out, and I think it's a clue that so too is the Fed. Let's hope we hold that 150 ball moving average on this downward move. Plus this whole thing right here, there's nothing wrong with calling this whole thing right here a flag. Look, this whole piece, we could easily say is some kind of a bull flag, right? You could drop a line up here, you could create a parallel to it and put one down here. And the next thing you know, if we drop a little flagpole right here, it'll look like we've got a bull flag in bonds. Now, I'm not going to call it an absolute bull flag. What I'm going to say is we are moving higher because I like the trajectory that you're seeing of these trend lines right here. So we'll turn them both blue, make it a little thicker. So now you've got us moving in a slightly more upwards pattern. And if you don't know how bonds work, you see this little illustration right here? Pretend that's a seesaw or, a teeter-totter out in a park. If you've got bonds on one side and interest rates on the other, bonds are dropping, the kid on the other side is going up. Those are interest rates. That's how it works inherently. You don't have to ask anyone. I promise you that's the way this works. So if bond futures are going down, interest rates are going up. Now, makes sense during this whole time. But look, now we're starting to work in that direction. I think the bond market's starting to tell us that the Fed's almost done raising rates, if not done already. So that's your bond market, and the 150 is you have to be patient and wait for it, but that's your trigger on bonds. Let's see what else we have out there to look at. Okay, so we're in the AB series, and we just did bonds. Let's see what's next here. Dollar index. Now, the dollar index, when we looked at it last, was starting to just finally come down from this massive rally. And the tip that we had back here was the 70 ball moving average seems to be magical on the dollar index. Why? I don't know. I don't care. I don't look to reinvent the wheel. But when I find the wheel Wall Street's using, I throw it on my car and rock and roll we go. So the 70 ball moving average seems to be locked in their algorithm. If you look, it holds all the way. It holds here, it holds here, it holds here, it holds here, it holds here again. Every time the market gets near it. And then when it finally gets under it, red arrow now, right? Or red circle with a red arrow, it breaks. All right, so now we got something different. Now you broke the 70 ball moving average. We go into a downward channel, and now the 70 seems to be keeping us in check. This chart seems to be here just because we looked at it last time. It's got nothing to do with the thesis of the bottom being in. I just wanted to show you every chart that we looked at last time. So being that the dollar popped up and it's there, the 70 ball moving average is your key to direction in the dollar. You sell it when it gets to it. If it gets above, you think about getting long. So that would be, I guess, the tip off the US dollar index. We don't really trade dollars though, right? But we trade instead on euros. The dollars, I don't really find a lot of traders getting into dollars. If you want to be in the dollar, you take an opposite position in the euro. So let's go look at the euro. So the euro was doing exactly the same thing the dollar was doing. For quite some time, it was holding that 70 ball moving average, but it was keeping it in check from going above. If you remember, the 70 ball moving average on the dollar index was holding it down here from going lower. Instead, it works as the opposite in the euro. So that makes sense. Euro and dollars are opposite each other. So that worked for quite some time. The tip is this on the euro. This is a good one. A lot of you trade this. The 70 moving average is no longer in vogue on the euro. It has moved. The 18 ball moving average is the new algorithm. I don't know why. Again, I don't care why, but there it is. And it's perfect. It's been working perfectly. So they switched to something little, like an 18-ball moving average, when the 70 was what they were using for a good 2 years. So right now, the 18-ball moving average is your trigger in euro currency. Keep that in mind. If you want to be a seller, sell under that average. If you want to be a buyer, buy when it hits the average. That's the 18-ball moving average in your euro. I hope some of this is helping you. And I hope looking at the charts now compared to where they were in the past is helping us see that this is way more bullish than it is bearish. The street, I think, is wrong. Let's keep looking at more charts. So we just did dollars and euro. What else did we look at next? We looked at Bitcoin. Now, here's Bitcoin before February 7th, right? Everything seems to have changed February 7th. It looked terrible. Head and shoulders, bearish formation, down it goes, leads to a bear flag, fails at the 200-ball moving average, and down it goes. Boom, 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 boom. Looking terrible, but it gets a little promising when it gets above the red line right here. So that's a little promising. So that's where it was, but I think what we want to look at is Bitcoin now. Just check this out. That's what the chart looked like when we looked at it in Feb. Check this chart out now. You're going to love Bitcoin. This is what Bitcoin looks like now. All I did was move from the ugliness of back there to where we are today. Bitcoin, Bitcoin, Bitcoin. You got to love this baby. Since it bottomed, it has been doing a fantastic job. It got above the 50-ball moving average, which used to be its sell trigger. As you can see, sell trigger, sell trigger. It gets above that sell trigger right here. It finally holds the 50-ball moving average. And you know Wall Street loves that 50. So it holds the 50, starts to go into this wonderful channel that we're looking at right here. Let me see if I can make that channel line a little deeper for you so you can see it. So check this out. Now we're looking at, well, I can just leave it like that. Look at the channel that was created. After that low was put in February, look at this wonderful channel and the excellent holds of the 50-ball moving average. And you're probably getting right back into that channel tonight or tomorrow. And it just looks fantastic. Even if it comes off a bit, Bitcoin is looking as good as the stock market. Why would that be? Because Wall Street's algos watch the 50-ball moving average in Bitcoin as aptly as they would in the stock market. So if Bitcoin stays above the 50 MA, it will attract buyers. And that's what it seems to do every time. Look what it did here. See how it attracted the buyers? So that's your tip on Bitcoin. If you're looking for a Bitcoin tip, whatever reason, the 50 came into play and it looks like the end all be all for Bitcoin at the moment. What I really like about Bitcoin is it's on its way to 85,000, which it should be there in about 3 years, 1 month, according to OMNI calculations. So Bitcoin's looking fantastic. Now let's get back into why the stock market is moving higher instead of lower. At least that's what we think it's going to do. Check this out. We looked at NVIDIA. If you guys, gals, traders remember, we were working back here at this thing called the knock-knock technique. Does anyone remember knock-knock-knock? And I said there is no shot that you could knock on this door 3, 4, 5 times without it breaking through. So it had knocked on the door 4 times when we looked at it last. The 5th knock came and it broke through. That's what we were looking at back then. The 90-ball moving average was our trigger. And as you can see with the 90-ball moving average, it absolutely is the trigger here, right? Everywhere you look, the 90 just worked so well. So the 90 was your trigger. Well, that trigger has changed, kids. It's gotten to a much smaller trigger. Once we got above the red resistance line and started to break out, we went from a 90-ball moving average to a 31-ball moving average. Watch this. Look how well this one works. Again, I don't try to figure out why Wall Street flips to these things. I just use them. We're here to go faster in our car, not reinvent them. So look at that 31-ball moving average, how well it's just holding the market up now. So they switched to a 31-bar algorithm, and we're in a bullish F flag inside of a bullish channel. That's enough to tell me that NVIDIA looks fantastic, right? NVIDIA is a big part of our stock market. Well, if the stock market is crashing, how come NVIDIA is going up, not down? All right, let's go look at something else. NVIDIA, look at, okay, Zoom. So this really doesn't need to be in today's presentation. Zoom is here because we looked at Zoom in our last presentation, and you guys were asking me what works on Zoom, and I pointed out the 55 ball moving average is your trigger on Zoom. It's still the same trigger. Nothing has changed. So the 55 ball moving average is your trigger on Zoom. It's still the same. I don't have anything to say about Zoom. Look at that chart. There's nothing anyone can say. So we're not going to spend any time analyzing it, but it was something in our past webinar. So I thought I would just move it forward. So what was working was the 55 ball moving average on Zoom. It is still the same. You can use that as your sell trigger when it gets to it. And what else do we have to look at here? Now it starts to get pretty, if you ask me. Now we start to get back into whether or not we're bull or bear market. The all-time highs of the Dow Jones, this is it right here. We put them in last year, and the market started to come off a little bit. Since then, we've put in this tremendous resistance line. Tremendous. Let me just grab a little tool for us. Look at this resistance line that started working here. You hit it again here. We hit it again here. We hit it again here. Resistance is working undoubtedly. What's the difference though? The difference is the low that you made. You put in this high, this low, a lower high, a lower low. And then suddenly we put in a high, right? You can't call that another high. So we put in a high to a low. And we come back and we're trying to work on putting in another higher high in the form of a pennant moving up. And as opposed to what was happening here, spending a lot of time below the 50 ball moving average, we are now spending a lot of time above the 50 ball moving average. So I think the Dow Jones is starting to look prettier, working its way up, but there's more convincing that we're going to go through, I promise you. And let's see, what chart are we working on right now? Oh, yeah. Okay, so we just did the Dow. Now, here's the one that really starts to get me. Traders, we're talking about the downside. A lot of people are. The street is, TV is. I'm talking about the upside, and I'm showing technical reasons why. If I'm wrong, the charts are backwards. You see this head and shoulders on the left? It's called an upright head and shoulders. We just move this little dialog box out of our way. This is called an upright head and shoulders, where you have the left shoulder, the head, the right shoulder, and that means the market should drop. Well, it did, and it stopped cold at the 200 ball moving average, and it got worse, and it just kept dropping, right? So we know that the head and shoulders brought us down. Well, if that's the case, we have an inverted head and shoulders right here, top day where we are today. That's the opposite view of the head and shoulders. That's up here, which is an upright. Well, if the upright head and shoulders made us go lower, shouldn't the inverted head and shoulders make us go higher? Isn't that the way it works, right? This one took us down. Shouldn't this one take us back up? The bottom seems to be in. We're above resistance. We're above the 200 ball moving average, and we've got an inverted head and shoulders. So that is bullish, not bearish overall. So the upright head and shoulders took us down. How come the inverted head and shoulders won't take us back up? Shouldn't it? Isn't that the way this works? Yes, right? This is the one that took us down. So we put a little box around this guy. This big head and shoulders took us down. Well, if we do an inverted head and shoulders, shouldn't that bring us up? Wouldn't this be the one to do the opposite? Yes, it would be, using technical analysis. One more reason why I say the market is more bullish than bearish. Let's go look at another chart. And let's see, some pretty charts for us to look at still. All right, now let's go into something else. You do realize that one of the reasons why we had this market come down the way it did was because the Fed had to raise interest rates to slow inflation down. Inflation gets created by raw materials getting expensive. Once they get expensive, it gets into the supply lines. Plus, we had supply line problems as well. But the biggest thing is always raw materials. If raw materials are expensive, you get inflation. Well then, If that's the case, let's go look at where the markets were at the height of inflation, where we are today, whether or not the Fed needs to raise rates any further. Here's where crude oil was at the height of inflation, not very long ago, at the top of these charts, just like all the other ones I've shown you. Crude was $130 a barrel. Crude is now $73 a barrel, got as low as 68. That is deflation as well as a stimulus to all of our pockets, because when the price of crude drops, the price of gas and energy drops immediately, and it's a stimulus. So we've got deflation. The Fed's trying to get prices down. Looks to be like it's working in crude, which is a stimulus to economies, right? So that one worked. Let's see what else we have. The next one that we have to look at is copper. Copper, a huge component to our economy, right? And to building. And if it's expensive, so is everything else. Well, copper used to be $5, $5.01 to be exact, at the height of inflation. Well, it's been dropping. It's got as low as $3.40, and it's trading $3.80 right now. Deflation, not inflation. The stock market, bottom is in, kids. Watch this. Well, inflation is why they had to raise rates to knock us down. If we're getting deflation, they can stop raising rates and allow us to go back up, right? So let's see what else there is. We just looked at copper. How about this one? Lumber. What's lumber not in? Maybe not in a Tesla. Maybe a little bit of wood in a Tesla. You never know. But lumber's in everything. You live in a house, there's lumber, right? Anything around you, if it's being built, there's lumber in it somewhere. At the height of inflation, lumber was $1,477 per board length. You know what it is now? $345. In fact, it's $344. It's $1 cheaper. That is deflation, not inflation. What the Fed has done has worked. They don't have to raise rates anymore. And I'm telling you, they won't, because of what I showed you, that 5 to 10%, that 7 to 10% with 100% risk, or 5 to 6% with no risk at all. No brainer. They got to stop raising rates. All right, but there's really no need to raise them anymore, because what they were trying to do is stop or stave off inflation. Lumber, that worked. What else did it work in? It worked in wheat. Look at the price of wheat. It used to be $1,161 for wheat. You know where it is now? It's in the 630s. The height of inflation, $11.61. Where is it now? 630. Kids, I am telling you, you are looking at deflation. Well, let me put it in caps lock. Not inflation. You are looking at deflation. Now, it doesn't get right to the product. It takes a little time. Raw materials get cheaper first. Eventually, the product gets cheaper. They'll get cheaper on your shelf. And if they don't get cheaper, what happens is competition will make them get cheaper, because someone else making the same product will get the raw materials cheaper and lower their price, hence causing other prices to lower as well in the same category. That's why the Fed's doing what they're doing, because all of that fits in. It all falls into play. When the raw materials get cheaper, everything else gets cheaper, and your inflation starts to go away. So that's wheat. And if you remember wheat, you know, now that the Ukraine's in war, there'll be no wheat left. And oh my God, what are we going to do? No, the inflation's going to get out of control. It's such nonsense. It's just what they sell on television, I promise you. All right, next. Let's see. We just looked at wheat, right? Corn. Another. This is in feed. They use corn to feed pigs, hogs, you name it. They feed cattle with it. They feed everything with it. If the price of feed is getting more expensive, the price of your food is going to get more expensive. But if the price of feed's getting cheaper, the price of your food will get cheaper. That's called deflation. You are looking at it on the screen before your eyes. It's not 760 anymore, right? It's in the 560s. It's going to end up in the 460s. Deflation has been taking place since the Fed started raising rates. I think they've done their job. I think they now can pause. And if they don't, it's going to be a disaster. Next, we just did corn, right? Let's go look at cotton. So cotton's industrial. It's in all of our clothes. And every store is using cotton for something one way or another. Every country's using cotton. It was 116. It has dropped to 80, maybe less now. It is dropping. Deflation, not inflation. Deflation makes a market go up. That's what we're looking at here. What else is there? The big one. Now, the reason why the Fed started to raise rates, of course, was to get the prices of things to slow down the stock market, slow down the price of raw materials, slow down the purchases of products so that more products can make it to distribution points, and getting rid of the bottlenecks, right? Raising rates helps to do all of that. When they started raising rates, the CRB index, the Bloomberg Commodity Index gauge of inflation, if you will, was at 140.55. It has dropped since the Fed started raising rates. This is all the commodities together that we call industrial, inflationary foodstuffs. They're mixed in here. We've dropped all the way to 103.60 in the measurement of commodity inflation. It is measuring deflation, not inflation anymore. Do you get me, kids? You see where this is going? The bottom is in. All of this shows us this was all opposite. What we spoke about, the markets were all opposite of what we're looking at now, at the beginning of this year in February. Everything now is opposite of what it was. This was going up last year, not down, right? Now it's going down. This is deflation, but there's more. Let's see, the NASDAQ. You know what? Let's get back to the NASDAQ. Let's go pull another chart. We'll get back to this puppy. Here, Dow Jones. Now we're going to go out to weekly charts. Traders, again, I'm trying to prove, because I get so much pullback, that the bottom is in already this year, and we're not in the middle of a crash. All right, so let's take a look at this chart right here. I don't know what this line's doing, so let's get out of our way. This is your Dow Jones Industrial Average weekly bar chart. It has held the 50-bar moving average like magic, except for during COVID. All right, I get that. During COVID, of course you'd expect it to crack. But it cracked very quickly. A few weeks later, got back above the 50, and then every time it tried, it was able to hold the 50, even if it got through momentarily. Now, so it's been holding the 50-bar moving average with a little bit of a blow through there only, but that created a flagpole of a bull flag. So the weekly Dow Jones Industrial Average, that, first of all, does that look bearish to you? If there's anybody who can answer any questions right now, even though we probably won't chat until I'm done showing you the chart segment, answer this. Does that chart look bearish to you? Does that look like a market that's breaking down? In other words, does that look like the market that we just looked at? So if you've got a market that starts up here and works its way down, and it looks sort of like this, then you're in a bear market, right? If you are trading in between these lines, you're in a bear market. If you are trading in between lines that look more like this, you're in a bull market, kids, not a bear market. You know what I'm saying? This is not a bear market. So I've been trying to show this to people for a while, but just look at my channel right there. Does that look like a bearish channel to you? Should that be red or green? You know what I'm saying? You wouldn't make this channel red. It wouldn't make sense. It should be a green channel. It's going up. So I don't know what the street's looking at, kids. I just don't get it. But let's look at more evidence. So that looks bullish to me. I don't know. Maybe I'm crazy that when a market's going this way, I call it bullish, and when it's that way, I call it bearish. Maybe I'm crazy, but that's the way I view things. We'll see what I can show you by the end of this segment. Let's see what else we have in there. Yep, we looked at the Dow Jones Weekly. We're going to look at the transportation average now. So the Dow Jones transportation average, a little different. The only difference is it's giving you two places to play. So once again, it failed to hold the average during COVID. I get that, right? During COVID, you expect markets to break averages. That makes sense. COVID's never happened before. It was a panic, but it comes right back above. The market gets back above these averages and starts to hold. What's interesting about the transportation averages lately, it's been giving us signals. When it gets to the 200, it's a buy. When it gets to the 90, it's basically a sell. I mean, it went up for a few days, but basically it's giving us signals. So we're sort of stuck right here between these signals. The transportation average, wait for it to hit the 200, then do something. Wait for it to get to the 90, then do something. And that's basically what I'm seeing in the transportation average. But I'm not seeing it as bearish by any means. So be patient. Wait for it to touch the 90 or the 200, and you can trade at either of the two. What else can I show you out there that I found in my bag of tricks? Transportation average. E-mini S&P. Let's talk about this chart for a moment. There's a big one. So your E-mini S&P has been coming down, or it was coming down for a while, right? And what we spoke about in the last webinar and this webinar is basically that the lows have been put in. And what you've seen happen here is proof that I am right, because yes, you broke the 200 ball moving average during COVID as expected. But look what happened when it tried to break it, even when Fed raised rates here. You held. Bingo. Held, created now what's the channels moving higher. Right now we're in a blue channel moving higher. No more in channels moving lower. So now you've got us moving higher above the 200 ball moving average. That's different because look, here it's been the same every time. You hit this and it's a sell. Same thing here, right? Same thing here. Same thing here. But look what happens when it gets here. This one's different right here. This one gets above. So we made it green. And then this one held. And it rallied out. So that's different, kids. That's a different complexion. It's starting to look bullish, not bearish. Now, anything can change. And if these charts change, I will be the first person to turn bearish. But they're not bearish charts right now. And here's the real kicker. Watch this one. This is the real kicker, this one. If there has been any doubt in your mind whether or not we're going up or down, let me show you one chart that'll sum up this entire webinar. And this is the chart. It is your NASDAQ on the weekly. So here's why I want you to look at this. And here's why I'm going to tell you this is our indicator of indicators. If you just follow this, I promise you, it will tell you what's going to happen next. And I'll show you how. It's a weekly chart. So on weekly charts, it takes a long time for things to happen, but they're also more accountable. Let's take a look. So what I like about the NASDAQ chart more than anything else is the fact that even during COVID, you could not break the 200 ball moving average. This average was not pierceable even during COVID. Not at all. We pierced it slightly right here and then held it, did another test, and started to run. After that, it held again, and I'm going to show you why I like this so much. Now, check this out. Yes, even during COVID, it held, which is an almost impossible thing to see a chart do, but it did. S&P did not. Dow did not. Transportation average did not. The Russell did not. Nothing held during COVID, the 200 ball moving average, except for NASDAQ. Well, that's got its own meaning right there. Now, let's go and look. Check this out. During COVID, it held. Anytime it ever got down there or near it, it held. But that's not all it does. Watch this. Let's go all the way back to 2008. You held 2005, you held every test, till 2008. Finally, that was enough of a reason for us to break. We broke the 200 ball moving average on the NASDAQ during 2008 one time. It got through it. It got back above it before 2009 or right into 2009. And it never went under it again. And here's what I want you to recognize now. What happens every time we hit this 200 ball moving average on the NASDAQ? You get a massive rally. Look at the channel. Massive rally after hitting the 200 ball moving average. So what does it do? It tries to hit it. After that massive rally, comes back and almost hits it. That was enough to send it skyrocketing. Tries it again. Sends it skyrocketing. Tries it again during COVID. sends it skyrocketing by getting near that 200 ball moving average. Look at this skyrocket that we get out of it. And what's it do? It gets back to it again. It holds, and it's heading back up. What's going to happen is the same thing that happens here. You get massive rallies every time you hit this, right? Massive rally takes place. Well, you hit it again. What takes place? A massive rally. Okay, well, that makes sense to me. What happens when you hit it again? You are going to get a massive rally. That's what happens when the 200 ball moving average and the NASDAQ on the weekly come together. So that's what you should expect. That is our indicator. That's what's going on right now. And I don't care what the street says. That's the Bible. That's where we're going. And unless the markets get hammered for some other reasons and we change complexion, for now, top day, this day, that's what's going on in the markets, kids. I wanted to make sure everyone was aware of that. I am tired of listening to people calling for the top. The top's in. We're going to have the biggest crash. The next shoe is going to drop. Not technically, not yet. If it gets that way, I'll be more than happy to prove out a downside scenario. I don't really have one right now. Traders, if you like what you are seeing here, please join me because as I mentioned, I put out YouTube videos every single night to tell you what should happen the next day. Then I'm live in my trading room taking you through those signals. So the trading room is this. You can easily join it. There are cameras on live over my head right now. There's usually a secondary camera on pointed right at me, but that's the one I'm using for the metastock presentation. 0 credit cards are required. Kids, it costs you nothing to come hang out with me. Let's pull metastock back up. So it'll cost you nothing to come hang out with me. And then if you like what you see in my live trading room, and if you like what you're seeing here in this analysis session, I want to show you just something else very quickly that maybe can help you. If you just come to my site, livewithoscar.com, and register, it takes nothing to register. No credit cards, no nonsense. You're choosing a first name, last name, phone number, password. It may go to spam. Check your spam. When you get out of that, you will literally just join me at livewithoscar.com. Once again, it costs you nothing. And here's what happens here. Let's take it for instance. I send out trading recommendations every single day, but I'm sitting live on camera, microphone, going through them. Quick jaunt at what we did today. Today, we traded gold, and the flash updates basically state this. Traders, second flash update comes out, tells you the time, and it says, the OMNI says to buy long gold at 2033 on down. Close is okay, so 2033.10, somewhere around there, get in. The last price is 2035.5. Place your protective sell stops below 2022. So it gives you everything that you need. Where you're getting in, the stop goes in first. So after that, I send you another flash update, and it rings, and this time it says last price in gold is 2053. Take your profits at market, cancel your stops once you're flat. Nice trade, Omniacs. So we made $20 in gold today. Right? We bought 33s, and we sold them out at 53. So not bad, right? So let's get in at 33. And when we got out at 53. We also traded S&P today. Signals came out. I told traders, let's get short S&P up to 45. Place your stops in above 62. When I say above, by the way, I use a lot of breathing room. If I say put a stop in above 62, rest assured I'm using 15 points above that. A lot of breathing room in your trades lately. But it says where to get short. And what I did was I actually got back out at the same price because gold gave us $20 in gold. I mean, it's $2,000 per contract. So we got out of the S&P at the same price we got in. Last price is 41.44. We did well today in gold. I'm exiting my positions. Now, when I send these trades to you, you get them in a fashion like this. You will receive a pop-up window. It'll tell you what to do. If you panic and close that window, you will find the very same trade is already listed right here. And of course, I shoot it out on a Discord channel, so you'll receive it on Discord. I basically try to encompass you with everything that you will need to be able to work with me, receive my signals. So you can get those signals at livewithoscar.com. But the coolest thing about all of this is if you go here, check this out. If you go to omnibootcamp.com, you can fill out an application and tell me about yourself. And if you tell me about yourself, you can set up a telephone appointment time and you and I can chat about you coming out and learning from me personally how to gauge the charts, how to come up with trades each day, and how to be a professional analyst and trader. I'm actually starting to do one-on-ones, by the way. So I usually hold a class of 5 people at a time. I think I'm going to do a one-on-one for a gentleman from the Netherlands when he comes out at the beginning of the month. So I am having an OMNI camp in January, March, April. Where are we doing this? In June? Yes, in June. So I'm having one next month, the beginning of June. It's right here. If you'd like to contact me, just come to omnibootcamp.com, fill out an application, and I'll be more than happy to chat with you about that. Now, Jeff, if there are any questions that I can help to answer, I'd be more than happy, but I know I've probably run out of time here.
You're all good. We started you late. So Daniel wanted me to send you this link around that talks about the Platinum free trial. I put the link in the chat. Do you want to talk a little bit about what that is?
Sure. So for you traders that are watching this webinar right now, I will be offering a free trial of my trading recommendations. For the next 20 days, you will receive them for absolutely free. Those same recommendations that I was showing you when I mentioned that you can see them on the site. So if you'd like these for free for the next 20 days, click that link or ask Jeff about it, and we'll be more than happy to set you up. Thank you for that, Jeff.
Of course. Let's see. A couple of comments here. And then I think Trader SLFA says, beautiful, crisp charts. Oscar is the oracle of trading charts. Tarek says, I'm a new trader and I gained a ton of knowledge. I'm just reading some of the YouTubes. You're just doing such a great job. I want to make sure to kind of give you some great YouTube videos, par excellence, great analysis of the market using metastock. Flash update service looks awesome. Just some really, really good comments. Had a couple questions. BB.
Sure.
BB wants to know, is your room primarily for futures trading only?
So we use the Omni on everything from stocks to ETFs and everything in between. But I have found that trading single stocks is more dangerous than trading indexes. In other words, if I buy a single stock, I am basically putting my money in and saying, I expect that this company will not have a report come out today that will ruin the company. They won't cook the books. The CEO won't stop his car on the Verrazano Bridge and jump off for no reason at 10 on his way to work. These things won't happen. The stock will be stable. Now, that's one stock. If you buy the S&P 500, you've got 500 CEOs. A few of them could lose their minds that morning, and it'll still go where it's going to go. So, yes, it works on stocks and anything else, but I like to use it on indices over individual stocks for the risk factor reason.
Jacob asked a question, I think that has to do with this chart. And he says, what about your knock-knock rule? So if I'm looking at the 200-day moving average, it looks like it's knocked a few times. Do you think there's any chance about a failure?
It's when it's knocking often. So
okay.
In other words, if let's say you started to hit it here, if I could just grab this, if it'll move. If we hit it at this green spot, and we hit it at this one, and then we hit it again at this one, well, that's knocking too many times now, right? That's playing knock-knock. What's happening here is you've got years in between the hits, literally. Last year, a whole year passes before you hit it again. So not the same as the technique that we were looking at, and I don't use it on averages. I use knock-knock on support and resistance.
Cool. All right. Let's see. What do you make of the news today that Warren Buffett dumped $13 billion worth of stocks?
Okay. I think he's smart for doing that, but you do realize he just put $40 billion into oil stocks, right? $40 billion. He's now the biggest holder of 2 oil companies, Chevron being one of them. So I think he just made some room for oil stocks, to be honest. He was just cleaning up his deck.
Cool. Let's see. Another comment that just came in on YouTube. I got a little great YouTube. Oh, we read that one. Okay, I think we're good. Since we have just a few more minutes. Excellent. Sure. Kishore says, excellent, Oscar, it was. You talked a little bit like Yoda there. Thank you. I'm glad you enjoyed it. Do you have any feelings on natural gas, real quick?
So, I've had some traders asking about natural gas lately, and I will pull it up, but I have to tell you, when you pull it up, there's nothing to talk about. We'll use May. Excuse me, we'll use July. And GN. So it's, yeah, that should work. It's not going to get us there, is it? You know what? We'll use the P. It'll be faster. So let me show you the natural gas most current contract. Why are we not getting natural gas, Jeff?
Try NGC1 as a symbol. That should pull it up.
One, that'll work for me. All right, let's close this. We'll do NGC1.
Uppercase NG, lowercase C1 would give you the continuous, which is the best I can do. I don't have the contracts memorized.
That'll do it. Okay. So what I had mentioned when a few people had asked me about natural gas is that if you look at it, I mean, it's just nowhere. It's nothing that I want to trade because it's sitting in this really horrible channel going nowhere lately. So because it's just sitting here doing nothing, I basically have been staying away from it. I think natural gas is worth $2 and should be at $2 because it's a free byproduct of shaling for oil or drilling for oil. We get our natural gas for free. So what I would tell you is just sell rallies in natural gas. It hasn't been a market that I've liked trading since it was worth $4. Anything under the fours, I don't like it at all. It's just, I think it's worth $2 personally, and it's where it belongs at some point. So I really have nothing to say about natural gas, sorry to say. It's just a boring market.
BB has a little bit of a funny question.
Okay.
He wants to know if you have an opinion on when deflation will affect egg prices.
Yes. So I've noticed that the time lag is generally 6 to 9 months. So being that we've already started pulling down and creating deflation, I think you're about 3 months away from starting to see it on the shelves, maybe 5 months. Somewhere right next, we've already started doing this. So, and again, why it happens on the shelves is if I'm selling cereal and I can now afford to sell it for $1 cheaper a box, I'm going to, so that the cereal box next to me from a different company doesn't sell as quickly as mine. And that's how the competition comes back down when the raw materials get cheaper.
All right, very good. I think that's good. We do have a lot of requests, so I just don't think we have time to go through them all. But I would encourage you, if you haven't, to sign up for the alerts. Go to the room. Oscar talks about this stuff. He lives, eats, and breathes this stuff. So go to the room and touch base with Oscar. So,
yeah, just join me when you get to Live with Oscar. You will click Chat Live with Oscar, and that's it. Once you click this, you're in the room with me. You just put in your password, username, and away you go. So you can come join me every day, and I do this every day of my life, and it won't cost you anything to hang out with me. So you might as well join me, kids. I promise you, you'll learn something good here every day.
All right, very cool. Oscar, thank you again so much. I really appreciate your time.
Very much.
Guys, if you yeah.
I hope to see you in my live trading room. Dano is always here to help. Dano in O-Town, by the way, is a fantastic. He basically is the back end, even though we've got a bunch of people that work for us. He is the back end when it comes to the trading room. If you show up at the site and you need anything, Dano will make sure that you get it.
He does a good job. We all like Dano.
Dano at livewithoscar.com will get you there. If you have any trouble signing up for my site, just contact Dano. Or let me give you a phone number, actually. I make life really easy for you. You could just call us at 702-629, if it'll let me type it. If you just call the office at this number, we can always help you out here.
Oscar calls it Live with Oscar, but I tell him you should call it Live with Oscar.
I say it should be called Live with Oscar because that's what it is. You just basically live with me. You live with me and we watch this craziness happen 24 hours a day like this. We watch this 24 hours a day. That's it. The charts we use to analyze, and then after that, we watch the ticker boards. We don't watch charts all day.
This question came up again, and I know I promised it was the last question, but this is the last question.
No problem.
Rito and a few other people wanted to know how you go about finding the best matching moving average.
So, okay, let's take a look. How would we find the best moving average? Let's go to a chart that will actually have a moving average on it. So we'll call it anything. I mean, I'm sure ES will. We'll just go with ES. So what I like is to find an average that stays out of the market's way. So like this would be too far out of the way, right? But let's let's say the 70, just to throw something out there, just to get us started. What's the 70 bar average doing? All right, well, that's something that's not really too involved with the market, right? So it's something that I'd prefer to use over, and I'm not saying use the 70, I'm showing you how to fish for an average. I'd rather use an average that barely hits the market, but when it does, it's meaningful over this, which is always in the market's way. It's always all over the market. In fact, let's go to something like what trades often? Crude. That's not crude, but we'll take it because it's a chart, and that's all we really need anyway. It's not enough data. Little C1. So lots of data on crude. What I like to do is just keep testing an average until I find one like the 200 that stays really smooth. I think the 50 is probably another, but I'll show you what I'll do until we get one that looks smooth. So let's go with the street loves 200. We know they love 52 and whatever reason, so we'll try that. So here's one that I would say you would like this because you see how it hits here? It's meaningful. It's meaningful here. It's meaningful wherever it gets ran into, but at the same time, it's not in the market's way. It's almost never part of the market unless something is about to happen. So that looks like a smart average compared to something, of course, that would be just running over it too many times. You know, something like this just runs over it too many times. I don't know what signal I should take, shouldn't take. So stick with the further away averages that sort of hover on the outside of the markets that don't cut through too often. And I think you'll find much more reliable averages.
All right. Thank you very much, Oscar. Livewithoscar.com, everybody.
That is it. Livewithoscar.com. I'll try to throw it up there before we walk out. That should be this, livewithoscar.com. And it's really easy to get to, and it's really easy to join me once you do.
Or even better, sign up for the the free platinum trial at the link below. Thank you again, Oscar.
Yes, absolutely. And see Jeff to sign up for that trial or call me at the office. Jeff, thank you once again. I love doing these presentations. I will do this anytime you need me.